Hi, this is Ann with Finance on the Offense, and today I'm going to go over a few things that you should do when the stock market crashes or goes into a downturn. And I'm also going to tell you a few things that you shouldn't do. All right, let's get started. Okay, so let's say you have $100,000 in your 401k, and your 401k is made up of mutual funds that hold a lot of stocks. Now, of course, this isn't always going to be the case because you can set up your 401k however you want. But I would say that most younger people who aren't close to retirement are going to have a lot of stock in their mutual funds inside their 401k. So anyway, one day you wake up and you check your 401k account and you notice that it's down $5,000 from just a week ago. And now you only have $95,000 in it. And when you go to work, everyone's talking about the stock market, how it sort of took a little bit of a dip. The Dow Jones is down, the S&P 500 is down, and people are starting to freak out a little bit. Next day you decide to check your account again, and this time it's down $3,000. So you only have $92,000 in there. And each day after that, it drops more and more and more. Here's a graph showing what happened in 2008. My dad had most of his retirement money in a 401k at that time, and it was mostly in stocks. And right here, his retirement accounts were down by half. Half of his retirement money that he worked for so long was gone. The reason I wanted to set up this scenario for you is if you have never been through one, actually being in a stock market crash and seeing your money fall every single day, day over day, is very scary. Your gut reaction is to just pull your money out of the market and put it in something safer where it won't be dropping every single day, like a bond or a CD or something like that. But here's the thing, you only lose money if you actually pull it out and sell those mutual funds or stocks. You still have the same number of stocks and shares, but they just aren't worth as much. Now, I do want to mention if you do decide to panic sell and you pull your money out of the market, if you do this, don't completely pull it out of your retirement account because you're going to get hit in a few ways. One, you're going to lose money when you sell those stocks at a low price. Two, you're going to have to pay a penalty for taking your money out early before retirement. And three, you're going to have to pay taxes in some cases. So if you do panic sell, leave it inside the retirement account and just get it into the account and out of stocks. So back to what we were talking about, you still have the same number of shares and number of stocks if you don't sell. They're just worth a lot less. So an example of this is, let's say you have 10 shovels and you bought them at $100 each. Then the price of shovels falls for whatever reason, and now they're only worth $50 a piece. Do you really want to sell them now, especially if you're pretty sure the price of shovels is going to go back up to $100 or even higher at some point? Probably not. So anyway, what should you do if the stock market crashes? By the way, everything in this video is not investing advice. I just wanted to mention that. I am just a random person on the internet, so you shouldn't be listening to me at all. But this is what I would do personally if the stock market crashed. The first thing is to be patient and do nothing. Just wait it out if you can. Now, if you're getting ready to retire or you need that money for some reason, this might not be an option for you. But let's take a look at a few more graphs. Let's look at what happened to the stock market over the last 100 years. Here's what the Dow Jones has done between 1920 and 2020. So it's fairly obvious that it's gone up. And as we all know, there are a few big dips in this chart. I'm just going to look at recent history, which is 2001, 2008, and then more recently 2020 with the coronavirus. This is the tech bubble crash right in here. So here it was at 11,000, and at the bottom of the crash it was around 8,000. But then the market came back and it ended up surpassing its highest point before the dip. Now, it did take a few years to do that, but if you're 15 or 20 years out from retirement, you can wait long enough to ride out the crash. Here's the crash of 2008, and with this one, the stock market dipped to more than half of what it used to be, but then it recovered. And here's the coronavirus dip right here. Now, this one recovered very quickly, and here we are today. Market downturns usually recover in 18 to 24 months, so just be patient and wait it out. The second thing is dollar cost averaging. Now, this is something you might already be doing if you have your money set to invest every week or every month. Basically, it just means that you're going to buy in on every Tuesday, or you're going to buy in the first day of every month or something like that. It's just very automatic. So if the price goes down, you buy the same amount. If the price goes up, you buy the same amount. And the idea with this is you get to spend your money on those really, really good days to be spending your money on stocks. And then you also are spending money on the days where it might not be so good. In the end, it all averages out. Now, this strategy comes really highly recommended by a lot of the finance experts. It's just a great way to remove emotion from the equation. The third thing is to smash that like button for the YouTube algorithm. All right, that's not the real third thing, but it would really help me if you did that. The real number 3 is buy good stocks on sale. Let's say you have $500 and there's an index fund you want to buy that usually costs around $100 a share. So normally you could buy 5 shares, but then there's a stock market correction, meaning crash, and now a share of that same index fund is only $50. So now you can buy 10. And as we saw before, the chances that the stock will eventually recover and surpass its former price are pretty high. Once the market has recovered or at least settled down, it might be a good idea to rebalance your portfolio. Now, depending on what kind of asset allocation you have, maybe it's 70% stocks, 20% bonds, 5% crypto, and 5% gold. You'll want to return your entire portfolio to those percentages. Maintaining your asset allocation is a really important thing, and it really matters based on where you are in life and when you're going to retire and that kind of thing. Now, there are also a few things that you shouldn't do if there's a market crash. Number 1 is panic selling. As I mentioned before with the shovels, selling your stocks when their price is really low just because you're freaking out about losing money is one of the worst things you can do in a stock market crash. Successful investing is about buying low and selling high. And when you sell in a crash, you're doing the exact opposite of that. The second thing is cashing out your retirement accounts and hiding them under your bed. Now, this actually, as I mentioned before, would be a threefold hit. Retirement accounts like 401ks and IRAs are tax advantaged. And for traditional accounts like traditional IRAs and traditional 401ks, not only would you be selling at a loss, you would also have to pay penalties and taxes on that money. So it's a really terrible idea. The third thing is you should not try to time the market. The fact of the matter is no one knows what's going to happen with the market. No one. It would be great if you could know the high point before a crash and you could just sell all your stock then, but nobody knows that. And by the same token, nobody knows where the bottom of a crash is either. Otherwise, everyone would just buy tons of stocks on sale. My first foray into the stock market was in 2008. It was around November or December, and my dad mentioned that he thought Ford stock was pretty low. I think at the time it was about $2.25 a share, and that was down from about $6 a share. Anyway, he said, if you want to try the stock market, now is the time, because everything was just so low. So I bought maybe $500 of the Ford stock. Now, really, it could have kept dropping and Ford could have gone bankrupt. It was a very scary time in the world. But then it recovered and it went up, and I ended up selling it, I think, at $12 or something a couple years later. Now, I wish I could say that somehow my dad knew that we were at the bottom of the crash, but really, we just got lucky. There have been other times when I tried to time the market and I failed miserably, or I invested in a single stock that I thought was really cheap and I thought it had a lot of potential, and then it just went straight into the ground and went bankrupt. So because no one really knows when the bottom of a crash really will be, a good idea is to just set aside some money that you want to invest. Then wait till the stock market is 30% lower than its highest point before the crash. When that happens, put half your money in. And then, if it goes to 50% lower, put the other half of your money in. There are tons of different ways that you could do this, but the nice thing about it is it takes all the emotion out of it and all the guesswork. So you know you're going to sell or you know you're going to buy at this point, and there's no emotion involved. Alright, I hope this video has been helpful for you. If you want to see more videos like this, just hit the subscribe button and the little bell next to it and you'll be notified every time a new video comes out. Alright, thank you!